Yeah, last week we were discussing the audit practice management, right? We're looking at the tendering process, okay? So we started, we said, we mentioned the fact that tendering is the process by which big organization uh, advertise to replace their external auditors, right? That's what tendering is. And I explained to us that the tendering process is divided into three main parts, okay? The initial consideration, the the tendering itself, okay, and the evaluation of the tender. That's what we were discussing before I had to leave. Now, we have talked, look at the initial consideration. We are saying that before you continue with your tendering process, you have to evaluate to be sure that this is something that you are. I was saying that at the second stage, which is the tendering process proper, right? The auditor, we need to be sure. We started the topic last week, okay? We started, not even last week, week before now. That's when we started. So if you go to the recording of the previous one, you'll see where we started, okay? So I hope I'm able to answer your question. So the tendering process is the second stage that shows that, oh, you are in for it and you are good to go. So at this junction, what you need to do is that you need to now start your documentation, okay? Your tendering document that you're going to submit to the prospective client that needed your service, all right? So one thing you need to also realize is that at this junction also, we are expected to have conducted what we call what a preliminary audit risk assessment. What is the preliminary audit risk assessment? Now, the preliminary audit risk assessment is an evaluation of the client business processes. Okay, if it is an activity that is conducted to be able to have an understanding of what you are expecting or what you are expected to face or what you're expected to do when you eventually come on board. Okay, so those are the things you need to now put into perspective in this second stage when you are compiling your audit documentation. I mean your tendering documentation, which I call the tendering document. Okay. Now, one thing you need to also note here is that at this stage, right, you need to uh, collect background information about the possible client, that's your prospective client. You need to get documentation about them. You need to do your fact findings, you need to carry out due diligence, okay, about the promoters of the business or the organization. You need to do due diligence about the source of their income, okay? Who are the promoters? All of these are what you are going to do. What you are trying to dig out is to be sure that you are not in any way aiding and abetting unlawful activities. Because if at the end of the day you find out that, let's say your client or prospective client is into money laundering activities or unlawful activity, you'll be seen an accessory, okay? You'll be seen as an accessory to the crime, okay? So that is why you need to do carry out a background check, okay? Okay. Then you also need to, in the process of collecting background information, you also need to be aware of whether the fees is to be set by tender or by any other method. So sometimes they will have pegged the amount that they can offer. All right. So if that's the case, that makes all good for you, make it all easy for you. But sometimes they leave it open, expecting the prospective audit firms, right, to give in their, I mean, to put their what, their fee and be able to justify why they are charging that amount. Okay. The second thing you need to also note is that at this junction, you need to establish the precise scope of the work to be performed and the specific requirements of the prospective client. The only way you can do this is when you have conducted what we call what a preliminary audit risk assessment. Okay. Then after the next thing you need to do, like I said, you carry out a preliminary audit risk assessment and prepare a preliminary plan for the audit. Okay. The plan must cover. So the essence of this preliminary audit assessment is you to have an evaluation of an overview of what you intend to do, the staff requirements, the scope of work, the time to be expended on the engagement, All of these are what you are going to achieve after you have conducted the preliminary audit risk assessment, okay? Also, at this juncture, you need to also state your fee. Okay, you need to state your what? Your fee, how you arrive at the fee. It's not enough for you to just say that you want to collect 10 million or 20 million. You have to state, you have to justify how you came about that fee. Because in some of those explanation or justification, there might be some you say that, oh, we don't need this one. Okay. So that will be able to for enable them to have understanding of how you arrive at the what at the audit fee. Okay. Then you also need to also ensure that you meet up with the deadline for submission because they always have a deadline for submission. Okay, that is, you say that this deadline is open for 1 month or open from the day of this advert. Mind you, this advert is usually posted in the national dailies, okay? Dailies that are widely circulated across the country, okay? It's not something that they do secretly because these are companies that are publicly listed entities. Like I said, this tendering process is for companies that are big. So when you say companies are big, you mean companies that they are already publicly listed companies, okay? They are PLCs, okay? So they cannot afford to do anything in the secret. So everything must be what? Must be transparent and be open. All right. Now, one of the other document that you're also going to include in your tender document is your brochure. Some people call it brochure, some call it brochure, whatever name you choose to call it. What that document does is that it contains a summary overview of what your audit firm is all about. Okay, it's going to talk about the key characteristics of your audit firm. They're going to talk about the nature of the audit work and non-audit work to be performed. Okay, they're going to talk about a statement of requirements of the client and how the firm will comply with the outline of how the work will be performed. Okay, then you're also going to talk about in that your brochure, how you usually calculate your audit fee. Okay, how you calculate your audit fee, how you arrive at your audit fee, and other services that your firm could offer to the client. Okay, so all of this will be included in the tender document that will be submitted or shared with the prospective clients. All right. So the intention of all of this is that at the end of the day, right, there will be a need for you to give what? A presentation to the client. Knowing fully well that there are some audit firms, right, that are very good in compiling documents, but when it comes to public speaking, they might not be able to face the crowd, all right? Another thing you also need to note here is that presentation, right? When you're having your presentation is an avenue for the prospective client to assess your team. So they will be asking questions, right? Especially that you answer. They'll be looking at your disposition. They'll be looking at your composure. Okay, they'll be looking at your competence. They'll be looking at how 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 exposed you are. All of this will be tested when that presentation is done. All right. So that is the stage that all of this will be done. Now, when that has been done, after the presentation, they will now go back. The potential client will now go back and do what? Evaluate all the tenders that they have received from prospective clients. Okay. Now, when they are evaluating those tenders, these are the criteria that they put forward. Okay. In doing the what? The evaluation. The first thing they are going to consider is the fee. How much are the audit firms? How much are they charging for the service that they want to render? That will be top notch or top priority for the prospective client. Number two, they're going to look at other services that the audit firm can render. Okay, some might be able to render much more service than others. So all of this will be added advantage to whichever audit firm is finally selected to be their external auditor at the end of the day. Another thing they're also going to put into consideration is the geographical location and coverage of the firm's offices. That is, they would like to know, is your audit firm, is it located only in a city or in a state, let's say Lagos, or they have other offices all over the country or even outside the country, like the Big Four now. This is where they are going to have an edge over many other audit firms. Why? Because they have offices all over the world. All right. So in case you have your business or you have your presence in other parts of the world, the big four can take advantage of saying that, oh, you don't need to bother getting another audit firm in other part of the world where your businesses are located. We can also assist. We can also render service in that regard. All right. Then another thing you also need to look at is the expertise of the firm and its staff. So that will be evaluated when they take hold of when they get hold of your brochure. Now your brochure, like I said, we give an insight into what your firm is all about. So for instance, how many of us, I believe most of us know Taiwo Oyedele, he formerly works with PwC, right? He's a tax partner for Africa for PwC before he got this political appointment as the presidential task force on tax reforms. Okay. Now imagine you have that caliber of external auditor on your profile of your audit firm. You understand what I'm saying? So they will say, these people, they have top-notch professionals, okay? So that's another area they are going to also look at. They also look at reputation of the firm. That is, okay, all these firms that have submitted or indicated interest, how many of them have been found wanting one way or the other? Whether their clients have called them out, whether they have faced public scrutiny, or whether they have been shaded or criticized on social media or on news, okay? They look out for all of this, okay? They want to see that the reputation of the audit firm is still intact, right? Now, in Nigeria, that might be difficult to ascertain or difficult to adjudge. Why? Because in Nigeria, right, there is no audit firm that has been taken to court, okay, or that has been publicized for negligence one way or the other. We don't have it in Nigeria. This will only be applicable. This will only be applicable in advanced countries, okay? But by and large, these are the things they are going to check, okay, to be able to ascertain that everything is in what? Everything is in order. All right. So so pretty much that is what they are going to do. So at the end of the day, they are going to select the very best amongst the audit firms that have indicated tender. So that is all about the tendering process. So once the tender has been completed, the successful audit firm will be notified, okay? And that audit firm will write his own letter of engagement and present to the management and board of the prospective client to sign before the engagement will commence. So that is all about the tendering process. Any question, any comment, any observation before we proceed on this one? Question, comment, observation? Are we good to go?
Well, good to go, sir, for me.
All right, thank you very much. So I'll take that as a response from every one of us. So another thing that also play out when this tendering process is ongoing is what we call low balling. Low balling. Look at it here. Low balling. Now we want to discuss now. Low balling. Now, what is low balling? Now, low balling is a practice of tendering for the audit work at a very low fee with the objective of winning the audit. Okay. If it is successful in obtaining the audit, the firm will hope that it will be able to raise the audit fee in future years and will be able to recover losses on the audit fee by providing other more lucrative non-audit services. Okay, now let me explain what this one means. Now, lowballing is a practice. That means it is acceptable. Okay, it is what? It is acceptable in the service sector. So what does it mean? Now, I'm going to put perspective to it. So you have 2 or 3 audit firms, okay, jostling to get an audit job in a big multinational. You have the likes of one of the big four or 2 of the big four. You have S and Young, you have PwC, and the third audit firm is, let's say, my audit firm, Adebayo Desalu and Co. audit firm. Now, I'm competing against the other two big four. All right. Now, one thing that is very sure, okay, if I'm going to be on the same level with the big four, definitely and obviously, the prospective client will not in any way prefer me to the other two of the big four. Why? Because of so many obvious reasons. So what will I do? What will I do differently? So what I will do is that because I'm aware that there are other audit firms that would have shown interest in this kind of tender. Okay, I must have had that in mind. I wouldn't be expect that I'll be the only one that will indicate interest by tendering. Okay, I will assume that other audit firms, even the big four, might be interested in such a tender. So what will I do? I'm going to play out this strategy or this technique. So what I know is that the big four, there is a range of fee that they will not want to go below, depending on the scope of the audit engagement, okay? Regardless of the scope of the audit of engagement. So what I would do, let's get, for instance, this is a telecoms company, okay? Let's say this is a telecoms company, right? And this telecoms company, you know that they are big. So, okay, you know that the big four, they want to charge nothing less than, let's say, 50 million, okay? But you know that if you charge 50 million, you are going to lose out, or I'm going to lose out as the audit firm. So what will I do? I'm going to lower my audit fee, knowing fully well that when this evaluation is done, one of the first things they are going to consider or evaluate is what? Is the fee. That the big four, they will have given high audit fee in this regard, okay? So what will I do? I'll offer, let's say, 20 million. All right? It's a scheme, okay? It's a scheme, it's a technique, okay, that is used during tender. So I'll offer 20 million. So that will put me in consideration for that job. So the management and the board will now be considering what other values would this Adebayo Desalo and Audit firm have, okay, that will not be able to match up with the big four. So there's obviously there's going to be some level of what agreement and disagreement amongst the prospective clients, the management of the prospective clients. Okay. So luckily, when I did everything, when I submitted my tender documents or tendering documents, everything was fine. And even during presentation, I was able to impress the management and board of the prospective clients. So at the end of the day, I won, I was selected, I was given the opportunity to audit, or I was given the opportunity to be appointed as the auditor of these prospective clients. So I started the job with what? 20 million. When you fully aware that I have lost potentially 30 million, okay? So I started the job. After 6 months, after 1 year, they saw that I was good at what I said I want to do. They were impressed, right? Then I said that, okay, yes, we've seen that you have been able to deliver on your promise, okay, on your competence and your skills. We see that you are top notch. So, and we remember that when you had your presentation over a year ago, you said that you can also assist us in our tax planning and tax administration. So here's an opportunity for you now. We want to bring you on board as our tax advisor. Okay? You help us with our tax planning and tax advisory. You are going to render tax advisory services to our company. And they now ask you, what will be your fee? Now, at this material point in time, all what you have lost in the initial tendering, right? You are going to now bring everything to play now. So you are going, because of presenting your audit fee, presenting your fee for this tax advisory service, you are going to give it like a premium. So let's say initially you wanted to charge them 40 million naira before. Now, because you have potentially lost 30 million naira in the initial tender, you are going to say your fee for this service is 70 million. Now, what have you done? What you have done is that you have put the management and the board in a kind of a way that they cannot just pull out. They'll first of all consider, have you been able to deliver on your set promise, okay, as the auditor? The answer is yes. Did you demonstrate professionalism? The answer is yes. Are you capable of doing this work? Obviously, the answer is yes. So what they will now do now is to start negotiating with you, not to talk of say, okay, your service is high, this one, you cannot consider it, let's go and take another. They will not do that. They first of all ask you, then negotiate with you. Okay, how much it will be your final acceptable fee? From there, you start negotiating. Let's say at the end of the day, you settle for 50 million, right? Or you settle for 60 million. In a way, what you have done is that you have capitalized, you have gained what you lost in the initial tender that you did, where you quoted 20 million in that space. Do you understand what I'm saying now? So that act I just explained now, so what is called was low balling. I hope it is clear. Is that clear?
Yeah. Very clear, sir.
All right. Thank you very much. So that is what low balling is. It is allowed, it's acceptable, it's not illegal. It is allowed. So don't think so. In a question they ask you something like that happened, it is allowed. Okay, it is allowed. So there's no crime when you indulge in low balling. Okay. Now the next thing we're going to look at is agreeing the terms of
Hello,
audit.
sir.
Yes, please go ahead.
Yeah, yes, sir. I just want to ask question. Let's in the
Please go
process
ahead.
of in the process of low boiling, yes,
Low balling.
the service has been at least we have already get they have already appointed us as an auditor based on our that strategy. But in the process of now doing the subsequent bidding based on the other services we can render, if we have someone that is
Mm-hmm.
very good among the board
Mm-hmm.
in terms of
Mm-hmm.
negotiation, are we not
Mm-hmm.
at are we not shooting ourselves in leg in that regard? Because if somebody that's very good in negotiation and has already been aware of this kind of a process can still use
Mm-hmm.
that one as an avenue to bid low, one, it will be an advantage to the company as a whole, but to disadvantage to the audit firm, and that one might still affect them in their independent work because there might not be enough fund for them to carry out other activities. Just like by an observation, sir.
Thank you for your observation and from the angle at which you are looking at this issue. Now, everybody knows that audit firms, when we started this topic, right, we said audit firms, they are not for profit-making organization. They are not NGOs. Neither are they charitable organization. Neither are they Father Christmas. For them to be in business, they have to make profit. That's number one. Okay. Number two is the fact that whether any of the management is aware of this lowballing activity or not, provided you are going to justify whatever your point is. The issue here is that how are you able to convince them? And that is why I started with the only way that what you said will play out is when you have a client that you've not been able to live up to their expectation from the first engagement, where you have not been able to live up with the expectation of the first engagement, that is when what you said will play out. Remember, there's a saying that says that first impression lasts longer. So if you have been able
Yes,
to
sir.
deliver on your first impression, your first engagement, in ordinarily you will have wowed them. Ordinarily you will have wowed them. Okay, but if this is the case, like you say, let's say eventually, okay, this is what actually eventually played out. The best they can do for you is that okay, they'll need to meet you at some point, maybe at the middle point, and say, okay, we cannot afford to lose you because we have seen your expertise. So okay, give us some consideration. But whatever they are going to give to you, right? Whatever you are going to settle for, cannot be as ridiculously low as, let's say, you are starting off from the fresh ground. It can never be. How are we going to answer your question, sir?
Okay, sir. Thank you, sir.
All right, thank you. Any other question before we proceed? Any other question? Are we good?
Yes, sir.
Okay, let's continue. Let us continue. So we go to the next area. Agreeing the terms of audit engagement. Okay, ISA 210. Okay, agreeing the terms of audit engagement, ISA 210, and the objective of engagement letter. So let me explain what this one means. Now, remember I said that before any engagement commences, right, there is need for you to have signed the letter of engagement or the engagement letter. Because this document will give you the mandate, okay, to proceed with the audit engagement, right? So that is the first thing. Now, before this letter of engagement or engagement letter is signed, there are some activities that need to be checked at the back end. There are some activities that need to be what? To be checked at the what? At the back end. What do I mean by activities? Let me give an instance. So I'm going to use an example, then I'll come back to explain it using this particular audit engagement. Now, I know most of us are aware of, you all know Cristiano Ronaldo and you all know Messi, right? I'm going to talk on Cristiano Ronaldo because of this example. Now, presently, Cristiano Ronaldo plays in El Ali or something like that in Saudi Arabia, right? Now, Saudi Arabia is an Islamic country. That's first thing you need to know. Number two, Saudi Arabia is not a footballing nation. All the time that they have gone to any international competition or tournament, they've never won any major trophy. Even the just concluded, what's it called? Club World Cup that just ended some couple of days back, right? You can see how they played. Why am I driving at? Now, let's take a look at Cristiano Ronaldo. Cristiano Ronaldo was playing with Real Madrid before, right? Before he got the offer to come to Saudi Arabia. Now, when he got to Saudi Arabia, before he even accepted to join them, these are the things that they discussed at the back end. Number one, Cristiano Ronaldo, if you know his family, if you know his personal life, he has a girlfriend, which he called a partner. They are not married. They are not legally married. They are just living lovers, right? Although they had children for one another. They are not married. In Saudi Arabia, it is haram. Haram means it's an abomination, it's a taboo for an unmarried man and an unmarried woman to live together. It's an haram. It is an offense. Okay? In that place. That's number one. Number two, the wife is not a Muslim. The wife is, let's say, white, right? Let's say she's an European or yes, right? So he will not want to cover her body like the other women that you have in Saudi Arabia. I hope you are getting, you know where I'm driving at. Now, aside from all of these things, there are other considerations that you also need to ask them. For instance, if it comes to Saudi Arabia, what other benefits is he going to gain? Is he going to gain or benefit from that club? Aside from saying that, oh, you'll be the highest player, highest paid football player in the world. Aside from that, what other things are they going to is he going to benefit? All of these things will not be known to any other person until after he signed the deal with Al Ali of Saudi Arabia. Are you getting it? So before he came on board and they now put a paparazzi and said that, oh, Cristiano Ronaldo has joined Al Ali of Saudi Arabia. All of these issues I discussed with you now would have been settled at the back end. So it's not that when he signed, he will now say that, oh, you cannot bring your girlfriend, though. Your girlfriend is not a Muslim. You cannot come into this country. It's not after that. All of these issues would have been settled. So they gave him a some preferential treatment that, okay, come in with your partner. Come in with your partner without covering her body, right? All of these things were granted him before he can end up coming to Saudi Arabia to play on their club side. Mind you, what I said. I said that the only thing that is known to most of us is that he signed up with El Ali of Saudi Arabia. That is all. All these issues I'm telling you now, none of you will have considered it because you didn't know. That's why I said that in every situation, there's always an element of audit and assurance there. Now, I've explained that one to you. You understand what I'm saying now. So when it comes on board to sign the paparazzi, to sign the deal, what you just see, they will give him the jersey, he will sign some documents, and he say, voila, he's now a player in El Ali. That's what you see. That one has ended. Now, let's bring it back to audit. Now, before the auditor presents the letter of engagement to the client, they must have some back-end discussions. Okay? Back-end discussion is the fact is adult discussion that they are going to make some concessions. Because at the end of the day, this back-end discussion will make life easier for both the audit firm as well as the client. So for instance, these are some of the questions they are going to ask, they are going to discuss at the back end. Number one, the audit firm will ask before they present the letter of engagement, going to ask them, who is going to prepare the financial statement? Is the director that is asking the management now. Who is going to prepare the financial statement? And the manager will say that we don't know. The director will push it to them. You'll be the one to prepare the financial statement. Because I cannot prepare a financial statement at the same time come back to audit the financial statement. I hope you are getting it. So they will agree on that. Yes, we agree. We are going to prepare the financial statement. Number two, the auditor will also put it to them that the internal control system of your organization is not us that will put it in place. You are to ensure that you have an effective and efficient internal control system. They will agree, yes, it's our responsibility. Okay. They will also ask them, when I come for audit, you are going to provide me all necessary information, documents, personnel that I need to ask information from to be able to carry out a successful audit in your organization. I know usually I will come now, ask for documents, you say it's not available. We prepare the financial statement, it's not available. I would not want that. Do you agree that anytime I come, all of these issues, documentation, personnel will be granted to me? They say yes. Once they have agreed on all of these things, it's after then that the letter will now present them with what? With the letter of engagement to sign. It's after all of these issues have been discussed at the back end that the auditor will now present what? The letter of engagement for them to what? To sign. So that is that process that they talk about. So all what I just explained now are the terms and conditions, okay, that they need to agree before the audit engagement commenced, okay? I hope it's clear. So that's what I mean by that. Now, the issue is this. Some of us might want to ask a question and say that, what if the management refuses to agree to all of these terms? These are the things that the auditor will do. Number one, for instance, management that will not be able to, we don't have the competence to prepare the financial statement. So you help us to prepare it, and since we want to audit the financial statement, what we will tell them is this. If I'm to prepare financial statements and audit it, that means I'm going to qualify the audit report. There will be what? I'm going to do what? Qualify the audit report in a way that means that you are not ready to do what you're supposed to do. All right? So you mean that you say that I will not be able to express an opinion on the financial statement in the first place because I cannot audit what I prepared. So there's going to be a qualification of auditor's report. That's number one. Number two, if they say that we don't want to put in place internal control system, you be done to do all of these things, then the auditor will now have another option to say that, okay, if that's what you want, then that means I need to speak with my legal counsel, legal advisor, and I'll get back to you on the next action. And the next action will definitely be that, oh, I'm not going to accept, okay, to take off the appointment. So those are the terms. Again, these are what we mean by agreeing the terms and engagement, okay? These are what we mean when we talk about the ISA 210. These are all what I just explained now, and what you are going to be expected to know in that standard, okay? I hope that is clear. Any question? Any comment? Any observation? Are we good to go?
Good to go, sir.
All right, thank you. So we proceed. The next one to look at is the content of the engagement letter. Like I said, before you start your audit engagement, you must ensure that letter of engagement is signed, okay, by the client management. So these are some of the information, like I said, is not exhaustive. These are some of the information or content of the engagement letter. Number one, in the agreement letter, you will have the objective and scope of the audit. Every engagement has its objective. There are no two same objectives. Every engagement has its own objective and scope, area they are going to focus on. So that will be contained in the letter of engagement. Number two, the responsibilities of the auditor will also be contained in the letter of engagement. These are the things the auditor is expected to do. All of those responsibilities will be contained in the letter of engagement. Also, the responsibilities of the management, as these are the things the management is expected to do, will also be contained in the letter of engagement. Okay. Then also, in letter of engagement, we are going to talk about the identification of the underlying financial reporting framework. That is, what financial reporting framework are you using for this engagement? Are you using IFRS or you are using US GAAP? You have to state it, the one you are going to use. Okay? So you have to discuss with the client and agree on which one you are going to use. Is any of these two you can use, but more preferably you use the IFRS because you are in Nigeria. All right? Then the next thing you're going to, there's also contained letter of engagement is reference to the expected form and content of any report to be issued. So I'm going to talk about what are the information that will be contained in the auditor's report. All right. At the end of the day, you are expected to issue a report. What are some of the information that will be contained in the auditor's report? And in what form will this report come? Will the audit report be made or sent to the management? Or will it be presented at a meeting where they are going to talk about it? All of these will be discussed. All right. All of these will be contained in the letter of engagement. Okay. And much more. All of these and much more will contain letter of engagement. This one we have here, they are, let's say, they are compulsory information, okay, that needs to be contained in the letter of engagement anytime, any day. I hope that is clear.
Yes, sir.
So with this, we have rounded up practice management. Okay, with this, we just rounded up with what? Practice management. Okay, so we are going to what? The next chapter. If there's any question, please feel free to ask your question now. Is there any question, comments? Please ask your question before we proceed. Question, comment, observation before we proceed. Are we good? Are we good to go? Okay. So the next thing we are going to look at, the next chapter we are going to is chapter 7, planning. Okay? Planning. Now, let me give an insight into this planning. Now, after you have signed the letter of engagement, right? The next thing you're going to do is to commence the audit engagement proper. Now, the audit engagement proper is in 4 stages. There are 4 stages you need to go through. First of all, you need to plan the engagement. Secondly, you need to obtain sufficient and appropriate audit evidence. Okay, after you have obtained sufficient and appropriate audit evidence, you are going to evaluate and review the audit evidence you have gathered. Once that has been done, after the evaluation and review, you are now going to write your report. And by the time you are writing your report, that brings the engagement to an end. So all these stages I just mentioned now, they are referred to as what? Audit engagement cycle. Audit engagement cycle. You start with planning. The second stage is obtaining audit evidence. The third stage is evaluation and review of audit evidence. The fourth stage is reporting. So these four stages, right? These four stages are regarded as what? Audit engagement cycle. So you cannot start the second stage before the first stage. You have to go from stage 1 to stage 2 to stage 3 to stage 4. You cannot jump any of those stages. If you jump any of those stages, you will not achieve the same result. Okay? So you are starting with the first stage, planning. Now, the planning, right, is very, very important. But there are some things that you need to know about the planning. What you need to realize is that the audit plan itself, we are going to talk essentially on it, but before we start, I need to give some perspective to it. The audit plan you are going to use for that particular engagement, please remember that audit plan is iterative. What do I mean by iterative? It keeps changing until when the engagement is completed. So you might have set out that you are going to go this route for the engagement. When you get to the client's premises or offices, you discover that that route cannot work. So you need to change. You understand? So the audit plan is a document that is flexible or that should be flexible and can change, continue to change until when the engagement is completed. You need to note that. All right? Now, the standard that you're going to make reference to in this chapter, we are going to make reference to ISA 200, which is talking about overall objective of the independent auditor and the conduct of the audit in accordance with the ISA, okay? ISA 200. I want to make reference to ISA 300 that talks about the audit of financial statements. These are the two standards that we are going to make reference to in this chapter, okay? So let's proceed. Let's start with the first one, ISA 200. The ISA 200, like I said, is on overall objective of the auditors, independent auditor, and the conduct of the audit, okay? That's what this one means. What this means is that when you are drawing up your audit plan, right, or you want to set out for an audit engagement, you have to be sure of two things. Number one, that the financial statement is free from any material misstatement. I've explained extensively what we mean by material misstatement, okay? What we mean by that is that you must ensure that you can see the word they use, you can see the adjective material misstatement. You not just say misstatement. The misstatement must be so profound that it will have an effect on the information that is presented in financial statements. Okay, that's why we call it material misstatement. Then number two, the auditor must ensure, the objective is that the auditor must ensure that the financial statement, okay, is communicated, in line with the audit findings. That is, while it's presenting the audit report, right, all his findings are also presented. He or she is not going to just make a presentation of auditor's report and say that is it. No. If there are any weaknesses in the client internal control system, he needs to bring out evidence. He needs to bring out documents. He needs to bring out exhibits, okay? Audit evidence to buttress that point. For instance, if you discover that some documents are not properly signed or there is no supporting document, he needs to make photocopies of those things and present it to the board or present it to the management, okay, in what we call the letter of weakness or management letter, all right? That is what the ISA 200 is talking about. Now, also, ISA 200 also expects the auditor to ensure that he complies with all international standard of auditing relevant to the audit. Being fully aware that it is not all the international standard of auditing that are relevant to the audit. For instance, ISA 600 is on group audit. So you are doing an audit that is not for a group organization or a group of companies or a conglomerate. This audit standard might not be applicable for that particular engagement, okay? Number two, the auditor is expected to comply with relevant ethical requirements. We have looked at chapter 3, all those fundamental principles: independence, objectivity, integrity, rational behavior, conflict of interest. All of these things they must ensure that they comply totally, okay, with these fiscal requirements. Number three, the auditor must ensure that he plans and performs an audit with professional skepticism. Now, what do we mean by professional skepticism? The auditor needs to plan and perform an audit with professional skepticism. What do we mean? So as an auditor, you must have an attitude of what? Professional skepticism. What do we mean by professional skepticism? You must have a probing mind. Okay? It's an ability for the auditor to be able to have a probing mind to every audit evidence that is presented. When they give you any document, don't just say thank you. You need to ask questions. Is this the only document that is available? Are there any other supporting document that needs to be included? Okay. Are there other documents that are related to this document that I need? So by the time you ask questions, ordinarily, the client will not want to give you any information unless you ask. The client will not want to give you any information unless you do what? Unless you ask. So when you don't ask, they assume that what they are giving you is sufficient. And like I said, the characteristics of audit evidence is that it must be sufficient and what? Appropriate. It's not just one, it's not that it should be appropriate. And it's neither it should be sufficient. It should be sufficient and appropriate. Both of these qualities must be what? Must be satisfied. Okay? That's what we mean by that. So you need to ask questions. Anything they give you, you need to check it thoroughly. Then also, you need to exercise professional judgment in planning and performing the audit. You need to exercise professional judgment in planning and performing the audit. What do we mean by that? What we are saying here is that it is expected that because this is not your first engagement, right? You'll have gathered some experience in the past. The experience you have gathered in the past will serve as a leverage for you in this present engagement. So that is why you can set out to say you are going A direction. When you get to the client's business, you end up following the C direction. That is where your expertise comes in. Okay? So then the next thing also is that the auditor must ensure that he obtains sufficient and appropriate audit evidence. The auditor must ensure that he obtains what? Sufficient and appropriate audit evidence, okay? To be able to guarantee that he obtains what? A reasonable assurance level. All right? To make sure that he obtains what? A reasonable assurance level. Okay? I hope that is clear. Now we go on to the next one, the audit plan. What is audit plan? Now, an audit plan is a course of action decided in advance to achieve a stated goal or objective. An audit plan is a course of action decided in advance to achieve a stated goal or objective. Now, you want to write November diet examination. November is how many months away? Like 3 months or 4 months away. But you are set up that, oh, I want to become chartered by, let's say by December, when the result comes out. So you have to set your plan. So it's a plan that is decided in advance. It's not that it is when you now start to develop a plan. Like, that's why I'm using the example of those of us that are on this call now. It's a plan that you have put in place, you have decided in advance. I need to pass and become chartered come 2025, December. So you set your plan out, right? And you work towards achieving it. It's the same thing that the auditor also does. All right. Now, what you also need to realize here is that as an auditor, your audit plan is embedded in your audit strategy. I take it again. Your audit plan, okay, is already embedded. It's already inside your audit strategy. And I believe that we have talked about audit strategy. We have discussed chapter 6, audit approach. These are all the approaches or all the strategies the auditor intends to utilize in the course of performing the audit engagement. That is audit strategy. These are all the approaches, okay, or techniques the auditor intends to utilize in the conduct of the what? Of the engagement. We call it audit strategy, audit approach. So your audit plan is part of your audit strategy. Please note that. Okay? Now, the audit plan, in drawing up your audit plan, right? There are certain things you need to also put into consideration when you are drawing up your audit plan, right? You have to consider 3 factors. Number one, You need to consider your audit risk. You need to consider what we call what? Audit risk. We are going to explain audit risk shortly. You need to consider what we call materiality. Materiality. Okay? We also need to we'll talk about that in a short while. Then thirdly, you need to consider the use you make when you have a client that is operating in a computer-based environment. The use that you are going to get when you have a client that is operating in a computer-based environment. Don't you feel that when you have a client that's operating in a computer-based environment, and you have another client that's operating in an analog environment or in a manual environment, if I can use that word, they cannot be the same. The approach will never be the same. Okay? So all of these three things, audit risk, audit materiality, use of computer, these three things, you must factor it when you are developing or you're designing your audit plan. It's very, very important. Without these three things, you will not be able to carry out a successful audit engagement. Hope that is clear. We are going to explain each of them in a short while. Let's just continue. The next standard we are going to also discuss is ISA 300. ISA 300 is talking about planning an audit of financial statement. Planning an audit of financial statement. What this one is saying essentially is this. As an auditor, you must ensure that the plan you are preparing or you are developing is what is effective. Is what is effective. Then you must also ensure that as an auditor, you establish an overall audit strategy. That's what I just explained, audit strategy or audit approach. Then you must ensure that your audit plan indicates measures for direction, supervision, and review of work. What do you mean by direction? So as an engagement partner, that's what we started with in chapter 5, practice management, engagement partner. That is the person that leads an engagement. So it's one that is going to provide what? Direction. Okay? It's the same person, the engagement partner, is also responsible for providing what? Supervision. It will delegate the responsibilities amongst the audit engagement team. Oh, you go and do this. Oh, you focus on non-current, you focus on receivable, you focus on revenue, you focus on purchases. It will design and segregate the audit activities amongst the audit engagement team. All right. When it's done when they are done with the engagement, it's going to review what each of those members of the engagement team has done. Then ultimately, it's going to present that audit documentation and the draft audit report before the engagement quality reviewer, which we have also discussed earlier on in chapter 5. All right. So these are what the ISA 300 entails, which I just explained. Any questions, any observation, any comment on what we have discussed so far before we proceed? Question, comment, observation before we proceed. Question, comment, observation? Are we good? Are we
Hello,
good to
sir.
go? Please go ahead, sir.
Hello, sir.
Please go ahead, I can hear
Okay,
you.
I am looking at this planning and audit of financial statements, sir.
Yes.
This ISA 300 gave us
Yes.
three things that we should put in place.
Yeah.
The last one that mentioned audit plan should
Yeah.
include measures for the direction, supervision, and review of audit work.
Yes.
I want to ask that direction and supervision,
Yeah.
what's the difference? Because I feel it's something very similar.
They are not the same.
Okay, sir, please kindly explain, sir.
Would that be on?
Yes, sir, for now.
Okay, thank you. Now, direction, let me explain it in this way. You have two audit staff. Let me use this example. You have two audit staff. You gave them, they are working as part of your audit engagement team. Now, You ask the staff A, focus on non-current assets. Or the staff B, focus on current assets. These are two areas that you expect them to focus on. What I've just said now is I've given direction. Now, supervision will now come in at this point. Okay, or the staff A, let me see what you have done so far. Oh, in what I can see, it seems that you are yet to conduct asset verification. Oh, I can see the depreciation you have calculated. How did you arrive at your depreciation in the first place? How did you calculate your depreciation? Oh, okay. What I did is that I look at the asset schedule and I look at the asset schedule that was presented, and then I look at the 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 date or the time when the assets, because I saw that they had additional assets, right? So I look at the date they bought the assets and I calculated my depreciation from that aspect. Now, the game officer will say that yes, that's what I told you to do. That is where supervision comes. In the case of or the staff B, you ask, sir, when I was looking at the account receivables, I discovered that I need to circularize the debtors. I need to circularize the customers to know how much they are owing the business. That is a good observation. Go ahead and do that. I hope I'll be able to put perspective to the two of them, direction and supervision.
Yes, sir. Yes, sir. Thank you so much.
Is it clear now?
Yes, sir.
Okay, thank you. Any other question? Question, comment, observation?
Hello, sir.
Please go ahead.
The scope of work for
Yes,
external auditor on the client,
yes.
is it the same or is there any similarity with the scope of work of internal auditor of an organization?
Yes, now. It's not the same. They are different. They are different. Let me explain. Is that your question, sir?
Yes, sir.
Okay, let me explain. So, it's not the same. And this is the reason why. As an internal auditor of an organization, your audit plan or your scope of work, your audit plan will entail your scope of work. Evolves around every aspect, every area of the business. Looking at risk, looking at operation, looking at governance, looking at everything entirely. That is as an internal auditor. Now, for external auditor, your scope of work will not be the same as the internal auditor. Your own. Why, in the first place, why are you called to come and work? You are asked to come and check whether the financial statement presented or prepared is what? Is free of what? Material misstatement, and to see that they conform with the applicable financial regulatory framework, IFRS. So, because you are looking at what? Financial statements, what your scope of work will entail will be, first of all, looking at internal control over financial reporting. What internal control system have they put in place to ensure that financial reporting, that is financial statement that they are going to review, they are going to examine, is adequate or is okay. Okay? So,
Okay, sir.
what you are going to look at essentially as an external auditor is basically on risk and also on what? The operation, that is the financial statement or financial reporting. That is all. Those are the things you are going to focus on. It's not going to be the same. So the scope of work of the internal auditors is broader than the scope of the external auditor.
Okay, sir. Thank you, sir.
Are you able to answer your question?
Yes, sir.
All right. Any other question before we proceed? Question, comments? Question, comment, observation? Are we all okay? Are we good? Can we fire on?
Yes, sir. That's why I answer.
Okay, let's go on. Thank you very much. The next thing I'm going to look at now is audit strategy memorandum, or we call it audit planning memorandum, right? Either you call it audit strategy memorandum or you call it audit planning memorandum. It's the same. Now, what does this mean? I've already explained what audit strategy is. So this audit strategy memorandum, right, is a document setting out the main point involved in the planning process and the key planning decisions that have been taken. I take it again. It's a document setting out the main points involved in the planning process and the key planning decisions that have been taken. What I'm saying in essence is that this document is where all the things you intend to carry out in the engagement, you intend to perform in the engagement are done. You have highlighted everything. So it's going to serve as your guide throughout the engagement. So at the end of the day, when you're done with the engagement, you're going to go back to the audit memorandum and check. It's like a checklist, okay, of all the planning decisions that you have taken. To go and check if all the areas have been covered. That's why we call it audit strategy memorandum. Now, some of the information that will be contained in the audit strategy memorandum are what we want to discuss now. Some of the information that will be contained in the audit planning memorandum are what we want to talk about. Number one, it's going to contain information about the assignment objective and the report to be issued. That is, what is the audit objective and what is the report to be issued at the end of the day. You have to decide that, you have to put that in that audit strategy memorandum. Number two, you're going to also, in your audit strategy memorandum, you're going to include the audit timetable. That is, knowing fully well that obviously you don't have that client alone, you have other clients. You know, in the Big Four, they have peak period and they have off-peak period. There are peak periods between January to March. That is when most of them, or most times, they have to sleep over. The pressure is on them, okay, in their offices. Now, what that implies is that once you have given your client the time, that means that every time you go for the audit, that is the set time you always go for your audit. For instance, if you have said that your client will be visiting them in May, that means May next year is when you're going to visit them. So that means you have put that down and you have communicated that to the client. All right? The third thing is also, it has also included in the audit memorandum, if there has been any changes in the client organization or business or any external changes affecting the client business since the last audit. So let's say, for instance, the last audit they did was in 2024, right? Now, there's another one that is due in 2025. In 2024, we don't have the tax reforms. The tax reform was just approved in 2025, even though they are going to start implementation in 2026. But most organizations now, they are working towards compliance with these new tax reforms. It's not in January they now say, okay, let's start complying. No, they are working on modalities to see how they can start compliance with these new tax reforms. For instance, the one that has to do with staff salary, PE. He said that anybody that earns below 70,000 now should not be taxed. That's the new law. Yes, they are going to start implementation in January, but organizations need to start making decisions now. Do you understand what I'm saying? That is one. Two, there are changes now. There are wars, cold wars, war itself, cold war between US and China, then war itself between Russia and Ukraine, or Israel and Palestine. You understand what I'm saying? All of these wars, they have an effect on our business or on the country or in the country. For instance, since the Ukraine and Russia war started, the prices of some of these things we get from those places have skyrocketed. Before now, most of us think that all those Titus fish, salmon, monkrel, all of these fishes, we get them from Nigeria. It is now when this war started almost 3 years ago that you discover that, oh, truly these fishes come from Russia. Oh, they come from Ukraine. You can see that the value, the price of these fishes have gone up to what it used to be before. All right? Have gone up to what it used to be before. Someone is asking a question. If there is a change in an audit firm, how can you get the previous memorandum to see if there is a change? Okay, I'll answer your question. Don't worry. Your question is valid. I'll get there. Don't worry. So another thing also, let's say you are into manufacturing of flowers now. Flour they use to make they use in bakery, right? To bake bread, to make chin and all of these things. You can see that the price of these things have gone up exponentially since the Ukraine and Russia war started. Why? Because the wheat that they use, the main ingredient, the primary ingredient for making flour, mostly comes from Russia and Ukraine. Are you getting it? So those are some of the changes. Another thing that can also affect when you talk about these changes could also be maybe there is a recent tsunami in your organization. Tsunami here means that there is recently change of management. Let's say the CFO resigned, or the CFO was asked to go, or the head of human capital resources was asked to leave, okay, or the internal audit was just established. All of these are changes that you need to bring to the attention of the auditor in the current year that is under review. I hope that is clear. Now, to answer the question that Ufoma asked, he says, if let's say there is a change in auditor, that is the auditor that audited them last year is not the one that is auditing them this year, what would they have done differently to obtain some of those documentation of the previous audit? That is why we talk about carrying out what we call professional inquiry, okay, which I believe we have talked about in earlier chapter. So before you take up a new engagement, you must ensure that there is a good relationship between the prospective audit firm and the outgoing audit firm. You cannot say because you are coming on board now, then you take the other audit firm that is outgoing as your rival or as your enemy. No. You must discuss. You are able to obtain the previous audit working paper from them. That's what we mean by coordination. That's what we mean by cordial relationship. But if there's no cordial relationship, that documentation will not be exchanged. So because of the cordiality in the relationship between the outgoing and the incoming auditor, right, you'll be able to you'll be able to have access to the previous documentation. I hope I'll be able to answer your question, Ufoma. So let's continue. The next information that will contain in the audit study memorandum is the summary of key financial ratios and other ratios from previous years. Now, we have heard of ratio analysis. One of the indicators showing that an organization is at the brink of collapse is when you review their financial ratios, because they call it key performance indicator. These ratios are called key performance indicator. For instance, when you see your assets turnover, or you look at your asset test ratio, or you look at your return on capital employed, you see that they don't meet up with the expected standard that is supposed to be. Okay? They don't meet up with it. What does that mean? That means that there's an issue with the organization. So the auditor will want to see the key performance ratio. And mind you, these ratios are not the same for every sector. The ratios you are going to focus on in a banking sector will not be the same as what you are going to focus on in the real estate sector, or the one you are going to focus on in another gas sector. They are variant and they varied. Okay? So as the auditor, you need to know which of those ratios are important to your client in the year under review and for the previous year. Then in your audit strategy memorandum, you also need to contain planning decisions for the audit. Planning decisions for the audit, that is, how you intend to embark on that audit, how you intend to conclude on that audit in time, you have to also take that. All right. The next you also need to have in your audit strategy memorandum is the use that will be made of the client staff in the audit. For instance, if your client has an internal audit department, which is very crucial to any external auditing, there is a need for the audit firm to evaluate the internal auditor's competence. Since they started, what have they been doing? What have they done? What recommendations have they preferred? How many of those recommendations have been implemented? All of this will show that the internal audit department is what? Is strong and is effective. All right. Then he also needs to make use of external experts. Who are external experts? Who are experts? According to ISA 620, an auditor's experts are organizations or individuals that possess competence in other fields outside accounting and audit, which we have discussed in chapter 1, right? So you have people like surveyors, engineers, architects, risk management consultants, IT consultants, actuaries, lawyers, all of these people, they are experts, all right? So for the big four, it's not an issue because they always have them in-house. So in a big four, you see lawyers working in big four. You see surveyors working in big four. You see geologists working in big four. You see actuaries working in big four. The only people that are going to have issues with using the expert are the small, medium audit firms, that they have to outsource the service of these experts when they are going for an audit engagement. Okay. Then also in the audit strategy memorandum, possible problems areas. Possible problem areas in the audit and the approach to be adopted to deal with it. So the auditor should know the critical areas where it poses challenge to him or her as an auditor. Okay, he needs to know. That is the essence of you conducting a preliminary audit risk assessment. You need to know all the critical areas of the business. Then also in your audit strategy memorandum, you need to state how many staff you are going to require for the audit and the planned location of the work between members of the audit team, time management, and record of previous audit engagements. What do we mean? It will be absurd to start an audit and say that, I think we need one more person. It's going to be very, very absurd. Why? Because as an audit firm, you ought to have planned adequately for every engagement. So the number of audit staff you are going to require, you need to have decided that even before you set out on the engagement. It's not that when you start the engagement, we need an expert, so let's get an expert. No, you must have decided that before you start. All right? Then how long are you going to spend in the client's environment or offices? That's when they start when they come for the opening, they always tell you, this audit is for 2 weeks, this audit is for 3 weeks, this audit is for 1 week. They always tell you because they have already allocated their time. Okay? They have allocated their time. The other thing you also need to include in your audit strategy memorandum is the attendance location. Okay? Attendance location of the client business. So if the client has branches all over the world, like the banks or Dangote, okay, like the banks or Dangote. Now, that will inform you on how to plan the audit. Maybe you need to send some people to the other locations outside the country, or you send a mail to them, expecting them to submit or present some documents or reports to you that will enable you to make an informed decision about the foreign subsidiaries or foreign locations. Right? Also, in the audit planning memorandum, you need to also talk about the proposed method of communication. How do you intend to communicate with the client? Are you going to be communicating with the client using email, or you are going to be sending, you'll be using social media, WhatsApp, or are you going to be having meetings intermittently with your client to discuss your findings? All of these modalities needs to be needs to be approved, needs to be reviewed and approved by the engagement partner before the audit commences. These are some of the information that are contained in the audit strategy, audit planning memorandum. Any question? Any question? Any comment?
Question, sir.
Please go ahead.
Yes. In the course of lecturing, you made mention of using social media like WhatsApp to get information and to disseminate information, to pass instruction, to get. But in the case of in the case where the chips are down, can we use that template as an information, as an evidence?
What template?
I
Social
mean,
media.
yes.
WhatsApp.
Is it tenable? Yes.
Yes, now. Social media is
Okay.
part of us now, whether you like it or not. It's part of us. We're going to look at that when we get to chapter 16 and 15. It's part of us. You can't talk. Okay, hold on. Let me ask you a question, Mr. Sheriff.
Yes,
Haven't you
sir.
seen that all the audit firms now, right? All the audit firms, they have presence in social media.
Yes, I agree
Go
with you,
to
sir.
go to Instagram, they have handles there. Go to Facebook, they have handles there. Go to WhatsApp, they have their WhatsApp handlers or platforms too. So it's an avenue. Because these days, the way the audit is going and the way everything is going now, it's not going to be the usual way that you have to be there physically. Okay? And this is
Okay,
to
sir.
light when we had COVID in 2020. When we had COVID in 2020, there was social distancing. So you couldn't go to the client offices to go and conduct audit. What did you do? That was when the era of Zoom, Teams, Google Meet blew out now. So
Yes,
it's
I agree with you,
acceptable.
sir.
It's acceptable, sir.
What really informed my question was that my former company, we do use WhatsApp to get information, get documents, and what have you. But in the case of getting reports, by the time I now refer that the communication ensue on the WhatsApp, an approval has been given. So my director will now ask me that, is there any formal mail to that effect? What of if that WhatsApp crash and I could not find it? Why would I use the mail as a backup so that I can get it printed in case of any eventuality? That one will serve as a source document, which technically it has nullified WhatsApp as non-valid source of getting information.
Okay, I agree with you, right? But if what you are saying, let's say you are talking about in the Nigerian situation, what you have said will be very, very valid. All right? In the Nigerian situation, very, very valid. But what I also need to clarify is this. Who says the mail server cannot be down? Who says the mail server cannot be down? Now, when WhatsApp is down, does it mean that the chat that you have on your various devices, everything will be wiped off? That's what we need to establish, okay? But the good thing about all of these things is that whether you are using email, you are using social media handles, you must ensure that whatever information you are getting from those places are properly documented. That is just it. Whether you print it out and get it scanned, or you store it in the cloud, any which way, just ensure that there is full documentation to back up whatever information you want to use.
I believe what he's trying to do is just to save me from some risk, so that when they are asking me of information and I'm not be able to provide it, it will become an issue on my hand.
That's what you are saying now. That's why I said that in Nigeria, right? In Nigeria to see, That might be a big challenge, okay? But in advanced countries, right? In advanced countries, we know in our laws, law of evidence in Nigeria has not been modified to incorporate all these social media platforms. That's the major issue. That's where the issue is. Once we change and revise our law of evidence, right, to incorporate social media, it will not be an issue again. But as I speak now, even the judges we have in Nigeria, the justices we have in Nigeria, you cannot present social media to them. Do you agree with me?
I agree, sir.
A good example is the case of VDM and Bobrisky. Remember that case? When he
Yes.
was summoned at the National Assembly, what did he say? He said the evidence he has is on what? Is on social media. What did they say?
Media.
You should go and present proof. And somebody now said that it cannot be true. That is AI. And that was why the case was dismissed. So,
Oh, sorry for getting much time on this. Oh. Now,
no
as far as
problem.
the financial environment is concerned,
Yes.
I would suggest that the professional body should look on how all these things could be adopted so that it can make our work easy and
Easy.
seamless.
Thank you.
Yes, sir.
I strongly support you. So that's the way to go. Remember the ICQM we discussed in chapter 5 has been approved since 2022. We are in 2025 now. We are just adopting it in Nigeria. You can see
Okay.
how laid back we are. So I believe in no time. By the time the crop of leaders that we are going to get going forward, both in ICAN and other professional bodies, they start to speak out. Because most of these people, right, they
Yes,
have
sir.
not embraced the social media. And once they've not embraced it, there's no way they can support it. That's just the truth. Most of the leaders in this country, they've not embraced social media. That's why they cannot see the need for them to incorporate it in our legal system. So once that has not been incorporated, there's actually nothing we can do. What we can only push and wait till when it will be implemented. Thank you, sir.
Yes, sir.
All right. Any other question? Any other question? So we are good to go. All right, let's continue. So we are moving on. We are still on chapter 7. The next we want to look at is information required to effectively plan and audit. Information required to effectively plan and audit. Now, there are two types of information you need. You need both the relevant information and the non-relevant information. What do I mean by relevant? What do I mean by non-relevant? The relevant information, these are the information that you are going to utilize purposely for that engagement. So what that implies is that in the course of gathering and obtaining your audit evidence, you are going to gather and obtain both relevant and non-relevant information. Both of them will be gathered. So the one that you are going, once you are done with the gathering, you now do what? You evaluate them and review them. So the ones that fit in as what you can directly use for that engagement, we call those one relevant information. All right? So like I said, before you even go about gathering information, you need to have gained understanding of the client environment. And that is why we have the ISA 315 that talks about identifying and assessing the risks of material misstatement through understanding the entity and its environment. Before you know which information is relevant and which information is irrelevant or non-relevant, you must have understood how the client business environment operates. What are the risks involved? All right. So that's what you are going to do. So the relevant information is what you are going to use for the engagement. Why the non-relevant information? What do you do with that one? You are going to use those ones for other audit-related services. You are going to use that one for what? Other audit-related services, okay? So for instance, you want to perform review engagement, you want to perform agreed upon procedure, you want to perform due diligence, all this other non-relevant information could be utilized to achieve these other purposes, okay? But what that means is that the objective of the audit is to identify whether material misstatement exists in financial statements. Therefore, information relating to immaterial matters, operational matters, that will not assist in concluding whether a material misstatement exists in financial statement will not be relevant to the what audit planning. So, like I said, those other ones, you are going to utilize them for other non-audit engagement and services. All right. So that is that. Any question on that before we proceed? Any question, comment, observation, contribution? Are we good to go?
We are good, sir.
All right, so let's continue. We look at audit risk. What do you mean by audit risk? Now, I've explained what the auditor needs to do. Before you go and audit any client, you must have gained understanding of the client by performing what we call what? A preliminary audit risk assessment, okay? A preliminary audit risk assessment, okay? To know what are the critical areas of the business, okay? You'll be able to know when you perform the preliminary audit risk assessment. Now, when you talk about the audit risk is the risk that the auditor will give an inappropriate audit opinion, right? Is the risk the auditor will give us an inappropriate audit opinion. But what you need to realize is this: before you even go about the audit, you need to define how you intend to go with the what? With the audit. So if you have adopted a risk-based approach for the audit, what that implies is that you are going to focus on what? The key risk areas of the client business. You are going to focus on what? The key risk areas of the client business. Okay? So those are the areas you are going to focus your attention on. Every business has its own area of criticality. It's not every area of the business that is critical. Every business has its own area of what? Criticality. So you need to identify what those criticality areas are. All right? So that takes us to audit risk. What is audit risk? I said audit risk is the risk that the auditor will give an inappropriate audit opinion. What do I mean? Now, when you talk about risk, it's a probability, okay? That is likelihood of it occurring, right? Now, audit risk, what it means is this: you are conducting an audit. If you have not gained understanding of the client business, if you have not understood how the client business operates as an auditor, there is high chance that your audit report will not be great. I take it again. If you are auditing what you have not understood, what you have not completely understood, there is high probability that the report you are going to issue at the end of the engagement will not be accurate. So there is that likelihood, there is that probability in every audit engagement. Okay? So the audit risk, I take it again, is the risk that the auditor will give an inappropriate audit opinion. And it has three main components. Three main components makes up the audit risk: inherent risk, control risk, and detection risk. Inherent risk, control risk, and detection. These are the three risks that makes up the audit risk. So by and large, the essence of the audit risk is that at every point in time, the audit risk is brought to an acceptably low level. You cannot eliminate it. You cannot eliminate audit risk, okay? But you can manage it to an acceptably low level. All right? So let's look at those components of the audit risk. Let's start with the first one, inherent risk. Let's start with the first one, inherent. Why do we call it inherent risk? Okay? This is the risk that items will be misstated as a result of their inherent characteristics. Okay? So the nature of the items themselves, okay, are susceptible to what? To manipulation. Let me explain what that means. When you say something is inherent, that means the thing is what? Is inborn. Is what? Is inborn. Now, every human is expected to sleep in the night. It's inherent. You have, no matter how hardworking you are, once it's night, once the day turns dark, you're expected to what? To sleep. It's inherent. For those of us that don't sleep, maybe you use stimulants like Nescafe, or you have other things you are doing that will keep your eyes open throughout the night. But ordinarily, by nature, once it's night, you're expected to sleep. So bringing it back to audit. Now, there are some account balances, transactions, accounts, right, that are susceptible to what? Inherent risk by their nature. That is, they can easily be what? Manipulated. Let me give you an instance. I'm going to back it up with evidence. Number one, your non-current assets. Number two, your current assets. Number three, your current liabilities. These three areas are just some of the areas or aspects of financial statement that, by their nature, they are susceptible to what? Manipulation. Let's start with the first one, non-current assets. With the exception of land, IAS 36 talks about what? Impairment of assets. What does this say? It says that at least once a year, every organization must test their assets against what? Impairment once a year. What does that mean? That means that you have to check the carrying value, that is the value you have for that asset in your books, in your financial statements, whether the value has increased or it has reduced. So if you don't carry out, if you don't perform impairment test, for instance, that means some of the assets that you have in your financial statements are either overstated or understated. So that has satisfied the inherent risk that I'm talking about. I hope that is clear. Let's go to the second aspect, current assets. Now, your current assets, let's look at them one after the other. Inventory. Inventory under IAS 2 says that inventory can be costed or can be valued using what? Weighted average or first in, first out. Now, if you have valued or you have costed your inventory using last in, first out, or standard costing, or replacement cost, what have you done? You have either undervalued your inventory or you have overvalued your inventory. So that has also satisfied the inherent risk. Right? Let's look at another one, accounts receivables or your debtors. Now, sometimes when clients include debtors in their financial statement, sometimes it's just a flaw. Okay? It's just really to disguise. They might not actually have debtors. So as an auditor, how will you know whether they have debtors or they don't have debtors? You need to obtain the list of all the debtors and do what? And circularize them. Ask from them, how much are they owing the company? But then you aggregate the findings, their feedback, the balances. You compare with what you have in the financial statement. If it's the same, that means it has been what? It has been validated. But if it's not, you might need to ask the management some questions. And further audit procedure will need to be what? To be performed. Are we together? The same thing with cash. Cash and cash equivalent. Your cash in hand. How do you verify that that cash balance that they put in the financial statement is correct? You need to have been there when they did what? The year-end cash count. What was the balance they have in the cash count at the end of the year? Is that same balance that they put, is it the same balance that they put in the financial statement? The same thing is applicable to bank. Yes, they say, we have looked at bank statement. Yeah, they use bank statement to prepare the bank transaction statement. A good auditor, I said, must have what? An attitude of what? Professional skepticism. The auditor will write the banks independently and request for a bank statement, a certified bank statement, because we have known now that bank statement can be what? Can be doctored. Bank statement can be what? Can be doctored. Okay? So the auditor will write the bank independently and request for the what? For the bank statement. What we now do is I will compare that bank statement that I got from the bank with the ones that they have used to prepare the bank transaction statement and see whether they are the same. Do you agree with what I've said? No, when you talk about inherent risk, it's not only on statement of financial position, it's all the financial statement, all. Not only, I'm just using an example of statement of financial position. I can use the example of what? Revenue too. Your revenue is on IFRS number 15, right? Revenue with contract. What does it say? It says revenue should only be recognized when it is what? When it is earned. And that means that all the 5 performance obligations must have been what? Must have been done, must have been performed. So let's say you sold something to somebody, a customer, last month, and the customer did not pay. The customer now paid this month. The customer now paid what? Now paid this month. What should you do? Are you going to post that money or that receipt in this month or in the previous month? If you post that money in this month, what have you done? You have undervalued your revenue balance in last month. And you post it this month, you have overvalued your revenue balance in this month. I can go on to all those inherent risk. I hope that is clear. Are we cleared?
Yes, sir.
Okay. All right. So let's continue. That is for inherent risk. Let's go to control risk. Second component of the audit risk. Okay? All of these examples are what you can use to understand more on what I've just said. I've already explained it, so you don't need to bother. You just read it and see how it's applicable. We go to the next one, control risk. Control risk is the risk that misstatements would not be prevented or detected by the internal control system that the client has put in place. Okay? Will not be what? Will not be uh, will not be detected by the client internal control system that he has put in place. All right? So that's what we mean by control risk. So let's give an instance to that. Just hold on. Let's put an instance to that. So for instance, right, in your accounting policy, you said that every procurement above 1 million naira, they must attach a local purchase order to any procurement. That is what you have in your finance and account SOP. Now, you now found out that your finance and account SOP, that's what you put there. Now, as the auditor, you now decide to request for the purchase schedule. Okay? And when you look at it, you just took a sample of your purchase schedule. And you discover that you sampled over 20 transactions in purchases. Only 2 of them, over 20 transactions that were above 1 million naira, but only 2 of them had LPO attached. What does that mean? That means your internal control system is what? Is weak. Okay? That means it's what? Is weak. That's what we mean by control risk. All right? The third one is called the detection risk. Detection risk. The detection risk is a risk that the audit testing procedures will fail to detect a misstatement in a transaction or in account balance. That's detection risk. What do we mean by this? This is the only risk that is applicable to the auditor. It's peculiar to the auditor. How do I mean? The first 2 we discuss, inherent and control risk, they are outside the purview of the auditor. All right? Now, this one, as an auditor, you have not gained understanding of your client business. Right? Your detection risk will be what? Will be very, very high. Okay? That the what? Your detection will be what? Will be very, very high. What does that mean? You cannot audit what you don't understand. You want to audit a client business now, but you have not understood how the client business operates. How do you intend to conduct the audit? It's going to be what, very, very difficult. Is that not? That's what we mean by that. So the audit test you have performed, the 10 of these tests would have failed to achieve questionnaire. All the tests you have done concerning internal control would have failed to achieve the what? The objective. All right? That is what we mean by what? Detection risk. So what we are saying in essence is this. As an auditor, you must ensure that your detection risk is what? Is what? Is very, very low. You must ensure that what? The detection risk is what? Is very, very low. That is, you must have gained understanding of your client's business. That is, you must have gained understanding of your client's business. Okay? That's what we mean by what? Detection risk. Now, vis a vis, if you put the three together, inherent risk, control risk, and detection risk, the relationship between these three is what we know as what? The audit risk model. Detection risk is what's known as what? The audit risk model. Okay? The same direction. If the inherent risk is high, right? If the inherent risk is high, that means control risk is also very high. I gave an instance of inherent risk, talking about account receivables, right? So if there is no record for customers in an organization, if you have not validated the records of customers and organizations, detection risk is always low. I take it again. When the inherent and control risks are high, the detection risk is always low. All right, they don't go in the same direction. So ultimately, the summary of audit risk is that the audit risk should be at an acceptably low level. The audit risk should be at what? Acceptably low.
Yes, we can hear you.
Network is breaking, right? I can understand. I think it's the network. I keep connecting and it keeps disconnecting. I'll take that what I said again. What I said is this. I said the summary of the audit risk is that audit risk should be at what? Acceptably low level. You cannot eliminate it, but you always keep it at what? Acceptably low level. That is what audit risk is. All right. Any question? Any question?
Yes, sir.
Any comment?
Yes, sir.
Yes, you go ahead.
I think you're making a statement which I did not actually get. You said that
Okay,
when the inherent and control, you said when the inherent and control risk is high, something is low. I didn't get that. I don't know if you can.
Okay, can you see my screen?
I can see it. I can see it now.
You can see it, right?
Now I can see it now.
Okay, that's what I was explaining.
Okay.
So what we are saying is that the inherent and control is when they are high, the detection risk should be low. Okay? That means that if the detection risk is low, that means high level of audit testing is required. That is, the auditor is able to sample large sample from the population. That's what we mean. But when the inherent and the inherent and control risk is low. The detection risk will be high. That means there is lower level of what? Audit testing. And that means that smaller sample sizes were tested by the auditor. That is what we mean. Okay? That's what we mean by that. And I said that at the end of the day, the essence of the audit risk is to ensure that it is brought to an acceptably low level. That is the essence of it. Okay? We must ensure that what it is brought to what? An acceptably low level. All right? Any question? Any comment? Observation? Contribution? Can we proceed?
Yes, sir.
Okay, let's move on. Let's look at the next one. Let's look at the connection between business risk, financial statement risk, and audit risk. Let's look at it. What do you mean by business risk? Business risk is any risk that threatens the ability of the business to achieve its objective. That's business risk. Business risk is any risk that threatens the ability of a business entity to achieve its business, its objective. All right, which is usually to make profit. All right. Now, what's the next one? Financial statement risk. Financial statement risk is what? Is the risk that the financial statement will contain some what? Material misstatement. Financial statement risk is a risk that the financial statement will contain what? Material misstatement. Okay? This is it here. Financial statement risk are, you can see. All right, you've seen it, right? Now, audit risk, I'll explain what audit risk is. So what is the relation between the three of them? Let me explain. There's a connection. There's a relationship between the three of them. Let's start with the first one, business risk. Now, the business risk is divided into, let's say, two. All right? The business is divided into what? Into two. We have the risk that are what? Business that are what? Internal. That is within the control of the business. Risks that are within the control of the business, for instance, high labor turnover. Staff are resigning anyhow. Okay? They resume today. By next month, they are out. Right? That's an internal business risk. What could happen could be that maybe the organization is not is toxic. Okay? The environment is what? Is toxic. That can make that to happen, which is something you can manage within your organization. Now, let's take, for instance, increase in cost of importation of raw materials. Increase in importation of what? Raw materials. That is outside the client's business. Okay? That is what? Outside the what? The client's business or control. So in that instance, what do you think the client will do? What the client will do in that instance is that you don't need to manage with what is happening. You cannot go and fight government, or you cannot say you no import. What do? You need to manage your business. You have to mitigate that risk. Okay? So what we are saying here is that your business risk has a part to play in your financial statement risk, as well as in your what? In your audit risk. 2 years ago says that the price of sugar should be what? Should be increased. That is the tax, the tariff on sugar that they import should be what? Should be increased. The reason is that the government discovered that majority of Nigerians are suffering from diabetes, and they believe that the diabetes that we are suffering from was a result of what? High sugar intake. That's government's belief. So it means that when you increase the price of sugar, people will be discouraged from buying sugar. Okay? And mind you, all the soft drinks we have in Nigeria, they add sugar to them. All of them. Now, if you look at another area of the economy, look at cigarettes. Cigarette also is another product that has high tariff on it because they said that smokers are liable to die young. Smokers are liable to die young. They don't want young people to die. So they expect them to do what? They discourage them from taking cigarettes. Another one is betting. Betting, all those companies that open betting companies, the likes of Bet Naija, Western Lotto, Winners Golden Bet, uh, Bet Bonanza, Sporty Bet, all of these betting companies, right? They pay as high as 66.6% of their profits to the government. They pay as high as what? 66.6% of their profits to the government, including Baba Jet, Premier Lotto, all of them. Why are they doing all of this? They don't want people to continue to indulge themselves in these betting games. But people are hardened. They still continue to do such. Okay? So what we are saying here is that let's take an issue of that sugar. And let me concentrate on that sugar. So sugar is used by Coca-Cola, 7-Up, Biggie, all of these people, they use sugar in the manufacturing of their soft drinks. Now, government say that if they use sugar, they will pay high tariff on the sugar. So they now look for alternative. The alternative that they use could be foolish saccharin, that's a sweetener, or could be date, date, right? Could also be honey. Let's say they decided to use foolish saccharin. Foolish saccharin is cheaper and is sweetens more than even sugar. So, but what they have done is that rather than for them in their financial statement say that when they are preparing their financial statements under the cost of goods sold, raw materials purchased, you should have put what? Sugar as part of the things that they bought. But they will not put sugar. They will go and put what? They will not put polysaccharine. They will go and put what? Sugar. Just to do what? Just to evade or to avoid government sanctions. Because at the end of the day, FRS will still come for audit and request for their what? Their financial statements. And if they take a look at the cost of goods sold, or they look at the bill of material or bill of lading, they are going to see the makeup of what makes up their cost of goods sold. Okay, so you go and put what? They put sugar there. They go and put sugar there. Okay, and they will not use polysaccharin. Or in another instance, they might decide to even put polysaccharin there and not put what? Sugar. All right. Now, if they do so, and they have understated or overstated their profit in that particular year. When they do that, what have they done? They have committed what we know as what, or they have been what we know as what, financial statement risk. That is, there is material misstatement in the financial statement. Now, the auditor that is coming to audit the organization, if he is not sound technically on this aspect of the business, that is to know that, oh, you can use sweetener, you can use sugar as part of requirement for manufacturing of what soft drink. If he's not aware of this, so we'll just assume that everything is fine with financial statement. And he also goes and gives a report that says that financial statement shows a true and fair view. Not mind the fact that there are some information or there's information in that financial statement that has been what materially misstated. Do you understand what I'm saying? So if there's going to be an issue in the financial statement, it will start from the business risk. And it will now influence the financial statement risk. And ultimately, it will affect the auditors in terms of what? Their audit risk. So the essence here is that as an auditor or as a business, we must ensure that we comply with all the relevant laws and regulations. That's number one. Then as auditors also, we must be highly technically sound, okay, in our chosen line of endeavor as external auditor, so that the risk of giving an inappropriate audit opinion will be what? be reduced. The risk of giving will be reduced. Okay, so that is that about um, inherent, that's all about business risk, management risk, and audit risk. Any question? Any comment?
Thank you so
Okay,
much.
somebody's
Just
asking a question here. Come again on risk model. What I said is that the risk model is a function of risk and control risks are high, action risk is low, and vice versa. But ultimately, in some okay. So the summary of audit risk model is that the audit risk should always be brought